One of the reasons I find the world of finance and banking so interesting is that it's so different from the world that I usually live in, the world of math and science. A key property of mathematics is that we always define words to have a very precise meaning. And once we define them, we never change the meaning. That's sort of the building block of upon which everything else is based. And that's not at all true in finance. And I think that's madly interesting. So in this most recent crisis, it provides a great illustration of that idea. And we're going to discuss what happened in the crisis. But ultimately, the result of that crisis is that two very basic objects in the financial system, the US dollar and US Treasuries, were redefined in some way. Their meaning was changed. And this happened extremely quickly. There was a collapse at this bank, and within 2 days, there was a new meaning ascribed to these objects. And I think it's very interesting to understand how that happens, and also what are the consequences of that to the entire system. Because these objects are key to our entire economic system. Imagine that I got lucky and solved some famous open problem, and I published a proof, and everyone looked at it and thought it was amazing, and for years it was out there, and everybody considered the problem to be solved. And then someone noticed that actually deep in my proof, buried in page 278, is a line that 1 + 1 = 3. Okay, and this is really embarrassing because we all know that 1 + 1 should not be equal to 3. Okay, but what do? We've already accepted this. Well, we could solve the problem as they do in finance like this. We just introduce a new regulation that says, this: when added to 1 shall yield 3 if the addition was carried out by Anup on or before March 12th, 2023. Okay, and that solves the problem, right? Now we can just forget about it, consider the problem solved, and we can move on with our lives. And that's sort of what happened here when this bank collapsed, as I will show you. Now, I've made a few videos now discussing topics in finance. These two are about basic features of the banking system, and I'll not go over all of the ground I covered. But I do want to review some very basic facts, because I often see misconceptions about these concepts in the news and all over the place in the words that people use when they're talking about banks and money. Deposits at banks are created during the process of issuing loans. So if a bank has a certain amount of cash on its books and a certain amount of deposits, when someone wants to make a loan, the bank satisfies that request by just creating a deposit out of thin air. That's how our system works. And this means that as more and more people make loans, the amount of deposits goes up. The banks issue new deposits, and these deposits are not backed by any actual cash that's held at the bank. As the amount of lending goes down, this process is reversed. Okay, as loans are repaid, the process is reversed. So banks do not take deposits, and I often see sentences out there that say the banks have taken our deposits and they've used them to invest in XYZ. Okay, and that sort of has a basic misunderstanding already, because the banks are actually creating deposits. They are the creator of deposits. I think that's the correct way to view what's going on. Okay, the banks issue deposits, and then you transfer the deposits that they issued from one bank to another, and that issuance is happening when loans are created. And this is happening at a massive scale. So you can just go out there and count how much deposits there are. This is how much deposits there is in the US banking system, and this is how much actual cash there is. And you see that there is a massive gap between these two. If everybody wanted to pull their deposits out, they simply would not be able to today. There's not enough cash to do it. And this is across the board. It's not one particular bank. It's all banks. And it's a feature of the system we've designed. In fact, we've designed it this way to allow for the creation of money in a decentralized way. So another kind of sentence that I hear about this all the time that I find confusing is people talk about how this issue can somehow be resolved with regulation. And I think that's a very uninformed kind of statement, because this is a mathematical problem. Okay, no amount of regulation can close the gap between these two, because it's not at one bank. This is across all banks. Okay, so there's just no way to get these two back in line. The only way to make it happen is to have loans be repaid without new loans being issued. This is how these two, that would lower the amount of deposits. Or you could have the Fed just print money and insert it into the banking system. That would raise this bottom number. These are the two ways in which these two lines can move, right? And if we try to get the banks to stop lending, so that as loans are repaid, this top curve comes down and tries to meet the bottom curve, that would actually be a catastrophic change to our entire system, and probably lead to all kinds of crashes everywhere. Because our entire system is based on new money coming in this process. And that's why, the prices of all our assets keep going up. Imagine if there was suddenly no money available to borrow, to buy houses with. Okay. So you could repay your mortgage, as you keep going. But then if you wanted to buy a new house, the banks are like, no, there's no more money, because we're trying to bring this number down. Well, what's going to happen to the housing market? You do the math. Okay, and I think that's across the board for all assets. That would just be catastrophic. So the upshot is, I don't think it's reasonable to try and regulate to fix this problem. I also don't think it's really the fault of the banks. It's a problem with the design of the entire system. Okay, so we're in a strange place because of how the entire system is designed, and I think we're just going to go to a stranger and stranger place until we rehash the entire system. So how do I think the system should be redesigned? Well, the basic issue is that we need a system for the creation of money, and that role is currently being played by banks. And I made another video discussing what I think an alternative solution to that problem can be. Okay, that takes the banks out of the equation. So that's the way I think we should be doing it. But I don't think it's likely that we will get there anytime soon. Next, let me talk about the two kinds of assets that are involved here to explain exactly what happened at Silicon Valley Bank and what happened across the entire banking sector. There are two kinds of assets that banks buy in a big way, and then those are U.S. Treasuries and mortgage-backed securities. And U.S. Treasuries are widely perceived as to be the safest asset you can own. Okay, they're basically the asset that represents U.S. government debt. But just like any other asset, they have a price, and they trade on the open market at a certain price. That price reflects the interest rate that people want to charge the U.S. government when they're lending money to the U.S. government. And similarly, there's mortgage-backed securities, which are securitized versions of mortgages. These assets are owned by the banks to a massive degree. Okay, so here's a plot of the valuations of these assets held by U.S. banks, and it's close to, it's about $4.5 trillion. Okay, and it's going down. It's going down. It's going down because the Fed's fight against inflation is causing these assets to be devalued. As interest rates go up, the prices of these assets go down. And that's led to a lot of losses. Okay, so here is a nice picture from the Wall Street Journal. It shows the losses at Silicon Valley Bank, and then compared that to the losses at all other US banks. And the picture looks very similar in both places. The scale is different here. So, the losses at Silicon Valley Bank are like $18 billion, and at all other banks, it's like $600 billion. That's a huge, huge number. So what happened here is that as interest rates have gone up, banks have experienced losses. And when depositors feared that the Silicon Valley Bank would not be able to cover their deposits by liquidating assets, they fled. They left the bank. And that caused a run on the bank. And that caused a run on the bank and also spooked the entire system, because there's nothing particularly special about Silicon Valley Bank. Just like Silicon Valley Bank, as I've shown you here, all other US banks have had massive losses in these same assets that Silicon Valley Bank was holding. And so there was a potential that there would be a massive run on the bank, maybe. I'm not convinced that this could actually happen at other banks, because where can the money go? You know, Silicon Valley Bank was a small bank. You can take your money and transfer it to a big bank. Okay. But you can't actually physically take out $600 billion and stash it anywhere. There's no physical money available to even do that. Okay, so I'm not even sure what could happen to the entire banking system. And because it's across the board at all banks, I'm not sure where you would try and transfer your money to. Okay. But it could lead to, you know, if this was left unchecked, it could have led to all kinds of other panic. It could have led to banks en masse dumping their treasuries, which could cause interest rates to go up dramatically. Okay. And so that was a big problem. And so what did the Fed and the FDIC do? Well, the news media is focused primarily on the first thing they do, which is that they covered all the depositors at these banks that were in trouble. But I think the much more dramatic and interesting action that they took is the second one, which is that they redefined the relationship between the US dollar and mortgage-backed securities and treasuries. They simply rewired the connection between these kinds of objects. So right after the collapse of Silicon Valley Bank, the officials at the Fed and the FDIC and other government agencies met intensely for a couple of days, and they came up with a solution. And I would have loved to be a fly on the wall in that room when they were coming up with this stuff, because, you know, it's a really hard problem. How can you solve this problem? All US banks have bought these assets, and these assets have plummeted in value. So they're all in trouble. One thing you could do, maybe the most straightforward thing, is to say that the Fed will just go out and manufacture money and use that money to buy these assets, and so prop up the value. It's the kind of thing they've done in the past. But that's really problematic, because we are ostensibly fighting inflation right now, which involves taking money out of the system, not putting it in. So how can you resolve this contradiction? We're trying to take money out of the system. At the same time, we're trying to prop up the value of these assets. How can you do that? And when the bank was collapsing, I was waiting with bated breath to watch what they would do, because I think it's a really hard trap to get out of, and they found a way, and it's sure enough amazing. Okay, so what is the way they found? Well, they said they will lend to the banks. So they will take dollars, they can generate infinite amount of dollars. So they will generate dollars which can be used to lend to the banking system. The banks can trade in these assets whose value has dropped and use those assets to get money as if those assets were valued at their par value. So that means, if you buy a US Treasury bond and it's supposed to pay out $100 in 30 years, well, you can borrow against it at $100 right now. Okay, so you can get money that you would not supposed to have access to for 30 years. You can get that right now. Okay, and that's a massive change, because U.S. Treasuries are held by many large institutions all across the globe. China holds $1 trillion in U.S. Treasuries. The entire banking system holds trillions and trillions of dollars in U.S. Treasuries. In comparison to that, the intervention of the FDIC is tiny. The total amount of money that the FDIC has, which is what the news media has mostly talked about, is in the order of hundreds of billions of dollars. It's just an order of magnitude smaller. Okay, the intervention with assets or treasuries and mortgage-backed securities is much, much, much bigger. All right, so this itself would be a huge problem, because it would suddenly mean that treasuries have a superpower that they did not have before, right? Because now suddenly treasuries, you can do this new thing, trade them in for dollars, and you couldn't do that before. So that would, suddenly the value of, say, for example, Chinese treasuries would skyrocket if this was the only change they made. So they had to somehow try to eliminate the arbitrage that could happen here, where people would suddenly try to buy treasuries because they're more valuable after this change. In order to negate that, they introduced more rules. For example, they restricted the collateral that's eligible for these loans. You can only use these loans if you use collateral that was purchased before March 12th, 2023. Okay. And that's really interesting. So if you're a US bank and you acquire treasury now, that treasury cannot be used to obtain dollars in this way. But if it was purchased before March 12th, 2023, then it can be used. And even more interesting, so a few days later, as banks started to merge, they added a new regulation. This is number 11 that says, it's trying to figure out what happens if Bank A buys Bank B, and Bank B purchased the collateral before March 12, 2023. Does it count for this regulation? And yes, it does. It does. Okay, so that was decided on March 16th, 2023. Okay, so you can go through this thing and read it. I think it's very entertaining. It's sort of like trying to watch a chess game where the favorite is about to lose, or maybe it's unfair because the favorite is the entire system, and so we just are frantically trying to change the rules to make sure that doesn't happen.